Welcome to Breaking News to Trading Moves. Today we're looking at a specific set of numbers that just came out of the semiconductor space.
That's right. We're looking at the latest financial guidance from Analog Devices.
And, usually guidance from a big chip maker like this is just a sort of routine checkup on the economy.
Yeah.
But this release, it feels a lot more like a compass. It's pointing very clearly to where demand is flowing right now.
And just as important, where it isn't. It's less about one company having good quarter and more about what the data tells us about the whole ecosystem.
A clear split is emerging.
Exactly. So the plan is to look at the numbers themselves, and then we're going to walk through 3 categories of winners and 3 categories of losers that this data really highlights.
I like that. Cuts right through the noise. So let's start with the headline. Analog Devices, ticker ADA.
Right. They released updated financial guidance for their fiscal second quarter.
And the numbers?
The guidance came in strong. For fiscal Q2, they're projecting revenue to be approximately $3.5 billion.
$3.5 billion. Okay, and that's plus or minus a bit.
Yeah, tight range, plus or minus $100 million.
Yeah.
But that's the center point.
And what about on the bottom line, the earnings?
Adjusted earnings per share, EPS, the guidance for that is about $2.88.
$2.80.
Give or take about 15 cents either way.
So $3.5 billion on top, $2.88 on the bottom. How does that stack up against what Wall Street was expecting?
Both figures are above consensus. The street was, frankly, looking for softer numbers.
Why is that?
Well, there's been general sluggishness in some of their core markets, like automotive and industrial.
Yeah, that's the key, isn't it? ADI is usually the bellwether for the, I don't want to say boring, but the foundational stuff.
The foundational stuff is a good way to put it. Industrial automation, cars, 5G base stations.
So if they're beating expectations, is it because those legacy sectors are bouncing back, or is it something else?
And that is the pivotal question. They did mention some strength returning to industrial demand, which is, good sign for the broader economy.
Okay.
But the real catalyst, the thing driving the excitement, is data center AI infrastructure.
It always comes back to the data center build-out.
It really does in this market. And it's tangible here. This isn't just talk. This is hardware. It's showing up in the order books.
Right.
And that distinction, between the parts of the market tied to that build-out and the parts that aren't, well, that's what builds our list of winners and losers.
Okay, let's get into those categories. You've got 3 winner buckets. What's number 1?
The first one is what we're calling AI infrastructure enablers.
Enablers. Okay, so not the main logic chips. We're not talking about the GPUs doing the actual work.
Exactly. We're talking about the analog and the mixed signal chips. Think of them as the nervous system of the data center rack.
The plumbing.
The plumbing, the circulatory system, yeah. If you build a massive cluster with thousands of high-end GPUs, the physics of it all gets incredibly difficult to manage.
You mean the power density, right?
That's it, exactly.
Yeah.
The power density is just unprecedented. You need perfect regulation, you need signal conditioning.
Because if the power fluctuates even a tiny bit, the whole calculation could fail.
Or you could fry a very, very expensive board. And that's where companies like Analog Devices come in. They make the power management ICs, the data converters, all the silicon that ensures the digital brain gets exactly what it needs when it needs it.
And it's not something you can just swap out for a cheaper part.
No, absolutely not. The barrier to entry is high, and these components scale with every single build-out. A new cluster goes online, demand for these parts goes up.
So who's in this enabler bucket? We have Analog Devices, of course, ADI.
ADI is the poster child today. Then there's Texas Instruments, ticker TXN. They are just a giant in analog and power management.
TXN, got it. And you've got a third one on the list.
Microchip Technology, that's MCHP. They're very strong on the embedded control side, the microcontrollers that manage all the subsystems inside the server.
Okay, so ADI, TXN, and MCHP, the companies that make the physics work.
You got it. Without them, a GPU is just a paperweight.
Let's move to winner category 2. This one's related, but a step over.
Category 2 is networking and connectivity, specifically for the AI data center.
This is the bandwidth problem.
It's all about bandwidth and latency. These AI clusters, they have to act like one single giant computer. That means they need to talk to each other, and they need to do it instantly.
And this is different from standard networking. It's not about connecting to the internet. It's about connecting one GPU to another right next to it.
That's the key. It's what they call east-west traffic inside the data center. The tech here is high-speed switching, optical interconnects, things like that.
Because at a certain point, copper cables just can't keep up.
Right, you lose the signal. So you have to convert those electrons to photons. You need optics. And if these data center builds are accelerating, there's a direct pull-through for this networking silicon.
You can't build the servers without wiring them together. So who are the big players here?
Broadcom is dominant, ticker AVGO. They make the core switching chips that all the hyperscalers use.
AVGO, okay. They seem to be everywhere.
They are. Then there's Marvell Technology, MRVL. Marvell is a leader in the optical DSPs, the brains behind the fiber optic modules.
Marvell, MRVL,
Yep.
a third.
Arista Networks, ticker ANET, they make the actual boxes, the switches themselves, and they've really optimized their gear for these massive cloud data centers.
ANET, so it's Broadcom and Marvell for the chips, Arista for the systems.
That's a good way to look at it.
Okay, that brings us to the third winner category. We've got the support chips, we've got the networking. What else?
The third is semiconductor equipment and test. This is the ecosystem of tools.
The picks and shovels. But what's the specific driver here? Just more volume.
It's volume, but it's also complexity. These new chips use advanced packaging. They're stacking memory right on top of the processor.
And that's a very difficult process to get right.
Very. The yield rates can be lower, so if demand is strong, you not only need more wafer starts, you also need much, much more inspection and testing.
Because if you package a faulty chip into a $20,000 module, that's a huge waste.
The cost of failure is just too high, so the intensity of the testing has to go up.
And who benefits from all that complexity?
Applied Materials, ticker AMAT. They're the leader in the tools that actually build the circuits.
EMA.
Then Lam Research, LRCX. They specialize in etching and depositions, especially for the 3D structures in modern memory.
LRCX.
And crucially, KLA, ticker KLAC. They basically own the market for process control and inspection. They make the machines that find the tiny defects. Their tools become non-negotiable.
KLA, KLAC. So Applied, Lam, and KLA. The harder it gets to build a chip, the better it is for them.
That pretty much covers the winning side of the trade, the areas where capital is flowing to.
Right, but capital is finite. If money is flowing to those areas, it has to be flowing from somewhere else. Let's talk about the losers.
This is the other side of the coin. The first category seeing some pressure is mobile and consumer-heavy semiconductor exposure.
Now, that might seem a little weird to people. Everyone still has a smartphone.
Oh, for sure. The market's not going away, but the growth has plateaued. It's a mature market. And the investment logic here is all about relative performance.
The opportunity cost. Why own something growing at a few percent when the AI stocks are growing at, multiples of that?
That's it exactly. Plus, this whole AI on your phone idea hasn't really driven a big upgrade cycle. Not yet, anyway.
It's coming, but it's not here today.
And investors are focused on today. When the headlines are all about massive CapEx spending in data centers, that's where the sentiment and the money goes.
So who are the names feeling this rotation?
Qualcomm is the most obvious one. Ticker QCOM. They're the king of mobile chips, but right now mobile is just not where the growth story is.
QCOM.
Then you have Skyworks Solutions, SWKS, and Qorvo, QRVO.
The RF guys?
Yep, they make the radio. Intel, ticker INTC, is the big one. They're trying to pivot, but so much of their revenue is still tied to the client PC market.
INTC. It's been a tough story.
And then the hardware makers themselves. HP, ticker HHPQ, and Dell Technologies, DELL.
Now, Dell does sell AI servers, don't they? They've gotten a boost from that.
They have, and that's a fair point. But a huge chunk of their business is still selling laptops and monitors. And the market tends to paint them with that broad PC brush, which can weigh on the stock.
So HPQ and DLR are sort of in the waiting room until a real refresh cycle kicks in.
That's it.
All right, bring us the final loser category.
This is legacy hardware and IT services.
The old guard of enterprise tech.
Right. The companies that built, the first version of the cloud. The issue is a shift from what we call general purpose compute to accelerated compute.
Break that down.
For the last 20 years, data centers were built on standard CPUs. You bought servers from, say, HPE or Cisco, and you ran your databases. Now all the new money is going into GPUs for AI.
So if a company has a fixed IT budget, they're taking dollars away from traditional servers to buy NVIDIA chips.
That's the fear. It's a wallet share problem.
Yeah.
These slower growth legacy companies that don't have a clear AI story can get derated.
Meaning their valuation multiple shrinks.
Exactly. They're seen as ex-growth.
And who are the companies in this bucket?
Cisco Systems, CSCO. Their core business is connecting office buildings, and that's not a growth market right now.
Cisco, CSCO.
Hewlett-Packard Enterprise, HPE. They're in the server business, but again, that mix shift towards accelerated computing hurts them.
HP.
And IBM, ticker IBM. They have consulting, they have their mainframe business, but they aren't seen as a primary winner from the big cloud CapEx spend.
IBM, yeah, it's that classic value discussion.
It is. So this analog devices report, it really acts as a kind of filter for the whole market.
One report really can connect the dots for 20 other companies.
It draws a very clear line. On one side, you have the builders of the new infrastructure. On the other, the providers of the legacy tools. And the capital flows are definitely respecting that line.
It's a barbell trade. You're either long the build-out or you're avoiding the legacy drag.
That is the structure we're seeing play out.
It'll be a story to watch, whether that gap closes or just keeps getting wider.
And that all depends on whether this AI spending waves continues or if it slows down. But for now, the signal from ADI is that the spending is still very strong.
A clear picture of the battlefield. Before we wrap, I just have to remind everyone listening, please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for listening to Breaking News to Trading Moves. We'll see you next time.